Perfect. So hi everyone, it's Alex Ward here, the broker owner of Maxwell Devonshire Realty, bringing you our bi-weekly Strategic Partner Wednesday Education Moment series. Today we have Mark Claffey from Edward Jones here to talk to us a little bit about how COVID has affected the markets as well, what is going on, where he kind of sees things going, and how this is affecting people's purchasing decisions, not only in the real estate industry, but also for global GDP and that sort of stuff. So Mark, I'm going to hand it off to you. Feel free to introduce yourself and kind of get us rolling. At the end, I will have some questions from our viewers, as well as some questions that I know are being emailed to us to just ask away. So it's all yours, Mark.
Terrific. Well, thank you, Alex. Always fun to be on here and see your smiling face every once in a while. Yeah, I appreciate you reaching out to make this a thing. We've got actually Edward Jones has prepared an excellent presentation here. I do just want to keep in mind. Now it was prepared at the end of April, so it doesn't seem like that long ago. But with how dynamic the world has been over the past month or two here, some of the information we'll have to skim over because it's actually, I believe, a little bit. Some changes have happened since. So we'll cross that bridge when we get there. But yeah, that's about it. So again, Mark Claffey with Edward Jones, been with Edward Jones for a few years in the industry now. Oh, you were with me when I started, Alex, back at TD, or maybe not long after. It was 6, 7, 8 years ago at this point. So
time is flying by. I can't believe it's already been that long since.
I know, it's incredible. But yeah, either way, what I'm going to do here is I'm going to share my screen so that everybody can see my this presentation we put together. So you can see that's up there. Outlooks and opportunities. Perfect. So we had, quite honestly, a great start to 2020. So I'm going to dive right in, by the way. So great start to 2020. We picked up right where 2019 left off, which was a banner year for stocks and gave us, really our best performance since 2013 economically and with the stock market. Even bonds posted their strongest year since the early 2000s. However, as COVID gripped economies worldwide, the economy paused, markets plunged, and the second longest bull market came to a very abrupt end in a matter of days. So, by the way, Alex, I always like to ask people this question. Do you ever mix up bull and bear markets? Is that something you still do, or do you have a little trick for getting it right?
Bull means go up. Bear means run away, go down.
Exactly. So it took until 2 years ago, being in this industry for a number of years, until 2 years ago, I couldn't get them right. So a little trick that somebody told me: bulls attack by raising their horns, right? Their heads go up when they attack. Bears drop their heads before they attack. So a little trick. You're welcome for the future. If it ever comes up, that's how you'll remember. Anyways, I'm going to move on. So given all the uncertainty that we're dealing with, most of us are wondering how markets are going to perform in 2020. Likely with a whole lot of questions, which we see here, like, will we see a recession? What can we expect from the U.S. election? We're going to skim through a couple of things. But I like to think of this whole outlook as more of a jigsaw puzzle, right, where several pieces will fit together to create one unified, cohesive whole. So that's going to be the theme for our conversation today. We'll focus on these questions in front of you, again, due to time constraints, so we're not going to dive into each one on here. So if you want to see more or know more, again, we have time for questions at the end. Or, of course, feel free to reach out to me privately. My good friend Alex here has all my contact information. So, so moving on. So question one, will there be a recession this year? Now, keep in mind there's a difference between a stock market recession and an economic recession. So a stock market recession basically means that from point A to point B, whatever time period that is, we've hit minus 20%. Okay, that's a stock market recession, which we did see earlier this year. An economic recession is when spending across the country has been negative growth, I guess, in spending for 2 consecutive quarters, so for 6 months, basically. So that's what we're looking at right now. We don't usually know that we're in a recession until we have that data. So there's obviously some major challenges we're facing with COVID-19. The worldwide efforts to contain it, I mean, they're set to severely weaken global demand and supply for the first half year of 2020. So the economy is central to our whole puzzle here, because a healthy economy supports a healthy stock market and healthy returns. So our first key question is, will we see a recession this year? So unsurprisingly, we've seen a pretty dramatic change in our economic outlook as we've been dealing with this. So our efforts to limit COVID, they've disrupted supply, disrupted demand channels of growth. So we do expect a pretty significant contraction in our economy, and it'll be likely be the deepest in the current quarter. We're in the second quarter, April through June. We also think that the economy will start to rebound in the second half of 2020. So there's some positive news out of all this. But as new case growth slows down and the economy unpauses, right? So we can see here the economy is made up of four major pieces. Sorry, you'll see me keep moving back and forth. I have my second screen here. So, but we've got consumer spending, business investment, government spending, and net exports, basically. So consumer spending, or GDP, which you see there, the one on the left, is far and away the largest, most important part of the economy. It represents about 60% of the Canadian economy. The other three are obviously smaller, but still vital. So growth in net exports or trade has softened to near zero. We had some trade issues in 2019. We remember the whole NAFTA deal. Now COVID has just made it harder, right? So the virus is very likely to temporarily dampen all four components here. What needs to be realized, though, is that the economy was in a very solid position before this whole outbreak started. And that's important to know, because we believe it's easier to recover from a global shock like this on the back of a strong economy than if we were pretty unhealthy before coming in. So, but let's take a look at jobs, because that's a pretty important one here. So jobs in the wage report, for a little more detail on all this. So unemployment to start 2020 was actually near its 40-year low. So wage growth has been pretty modest compared to other expansions. The data from the beginning of 2020 showed it was picking up. So we're going to see that stronger wage growth. Over this past expansion, wages were actually growing faster than inflation.
Sorry, Mark, I'm going to interrupt you there. The statistics you're showing here for us for wages, is that for Canada or is that for Alberta?
This is for Canada.
Okay.
Yeah, not just Alberta. Yeah, so good question. But yeah, so it's over past expansions, wages were growing faster than inflation. Sorry, I have a lot of notes here. I'm reading the same line over. We'll move down. Unsurprisingly, so we do expect the unemployment rate to skyrocket here. We've already seen it happen as from record lows to record highs as our governments try to fix this issue. I mean, we had what, 11, 12, 13 million unemployment claims come in all over the place, right? So it's been tough on a lot of people, and understandably so. Now, for context, the 2008 recession brought a 9% unemployment rate with it. Back when I put this presentation together, we were just under 8%, and it's significantly increased since then. Likely rise even further before receding in late 2020. That's what we anticipate. So another important piece of the puzzle is inflation. Okay, so, or the rate at which goods and services get more expensive over time. I mean, you're in the real estate industry. You obviously know inflation and housing prices. It's a thing. You could buy a house or a chunk of land 50 years ago for a whole lot less than you could today. So this chart shows the CPI, or the Consumer Price Index, which is a common measure of inflation, and the core CPI, which actually takes out energy and food prices. So core is yellow, headline inflation is green. So it's been low over the most recent expansion. Below, Bank of Canada has about a 2% target. It's been below that. The more immediate risk right now is actually deflation, which is the opposite. It happens when the demand for goods and services actually weakens, which drops prices. It's basic supply and demand. If nobody wants something, it's probably going to be cheap. If everyone wants it, it's probably going to be expensive. Now, prices continue to drop. Everyone holds more cash and they invest less, which weakens demand even further. So it's a vicious cycle. So we do expect this whole thing to be temporary. Inflation is expected to soften in the first half here. But again, temporary. That's the theme of this whole thing is once everything unpauses, we do see it coming back. So we keep a close eye on inflation though, as it's one of the biggest risks people face as long-term investors. Inflation is eating away at the value of your money all the time. So your money needs to keep up with rising prices. Now the housing market, okay, so it's about as interest rate sensitive as you can be, and it's a leading indicator of a recession. Canada-wide, the housing market started to improve last year, the health overall, as new starts, new builds, they were increasing back closer to historical averages. Permits are an indicator of future construction, and they were actually signaling more growth in housing prior to COVID-19. Now, access to home equity can help consumers through rough patches. However, again, we do expect COVID to temporarily dampen sales, as people are like, and you can talk to this point, Albert, but Alex, as people are are likely not sprinting to their realtor for open houses right now and have a whole bunch of strangers come through at the moment. I've heard it's picking up, but again, you would know more about that. So, but putting all this together, we do think consumer spending is key to economic growth at the end of the day. The economy will continue to weaken significantly, but we do see it as very temporary. Lower business investment and exports continue to be a drag. It'll be made worse by COVID. On the flip side, this oil price dive has almost acted like a tax cut. If we think about it, my wife and I are a great example. We normally spend about $450 a month on gasoline for our vehicles. In April, I think we were at 105, right around there. So we're saving money in certain places that we didn't anticipate. But again, the oil price dive acts as a little bit of a tax cut for us unexpectedly. So we expect growth to be slow in 2020, a lot slower than 2019, that's for sure. And we'll likely see a temporary recession until we figure out how to restart and unpause. So very briefly, another question. Will we see rates go lower or even negative interest rates? So to continue this fun analogy with a puzzle, we usually look at the box of a puzzle to give us a sense of how it all fits together. So one part of that picture that's emerged is lower or even sub-zero interest rates. So this chart shows the actions of the Bank of Canada to either stimulate the economy by cutting rates or slow down an economy by raising rates. So they lowered their target to near zero from 1.75 to start 2020 to try and protect our economy, get people spending again. Remember, spending is about 60% of our economy. So on top of these rate cuts, they also announced new asset purchases and government bonds and other actions to keep credit flowing to businesses and consumers, because no credit equals no spending, which again, 60% of our economy, major part here. So we have seen some negative yields show up in a few places around the world, notably Germany and Japan here. Canada and North America, we see it pretty unlikely. There's limited evidence that negative rates actually work. And so we're unlikely to see them here. The Bank of Canada and the US Fed, they have other measures like asset buybacks. These have proven to be more successful. So we do see rates staying low until fears of a recession actually subside and the global economy improves a little bit. So am I moving too quick, too slow? Alex, you tell me.
How many more are you doing?
Well, I'd go through a whole bunch. But what I can do is...
Because you have about 10 to 15 minutes left.
10 to 15 minutes. I can move through a few of these and get through properly. Yep. Just tell me. That's all we need to do. Just tell me, stop me, and we'll go from there. But
9:35.
What's that?
9:35.
9:35. Okay. I don't have a clock anywhere here, so I'm going to have to rely on you.
Okay.
So the third question, how long will this market slump last? Now, the crystal ball is still in the shop, but what we can do is try and look at the data to navigate this question here. So after nearly 11 years, the third longest bull market in Canadian history came to a pretty quick end as stocks fell well over the 20% threshold to enter into a bear market from mid-February to mid-March. The reason was very obvious, uncertainty over COVID and how it would impact economies around the world. We have been bouncing everywhere. We've seen minus 12% one day, plus 12% the next. I mean, that just reflects the total uncertainty about this virus and the extent that it spreads. So as unsettling as it feels, though, there are three key takeaways for some perspective. One, initial conditions matter. We had a strong economy prior to this. Two, the Bank of Canada and the Federal Reserve in the US have injected a lot of support everywhere in response to this turbulence. That'll help the economy buffer the impact here, and set us up for a pretty good system to climb once everything passes. And third, a diversified portfolio that won't match the market's decline. So you maintain the diversity with investments from all over. They work together to make sure that you don't lose your shirt when things drop here. So for example, as stocks plummeted recently, bonds actually fared relatively well or didn't drop anywhere near as much. So you want a little bit of both when you're managing through this. So while stocks are in turmoil, we think the economic fundamentals will be solid enough to support that eventual upturn once the new number of cases recedes and the immediate concerns dissipate. So earnings growth is a huge question mark here, which is something we'll take a look at. Companies continue to assess the damage. We've seen companies remove their outlooks altogether. They don't know what to expect here, and reports are starting to come out, and we're seeing exactly what we thought, which is not good news. So earnings are the key driver of stock returns over time, or one of them, and we can see that here. So earnings per share is the gray shaded area. So this is what companies will actually report or expect as earnings per share. And then the S&P 500, which is a main index in the US, is the yellow line there. So you can see they follow each other. There's a pretty strong correlation there. Now, earnings will likely to continue to be revised downwards as the year goes on, and growth rates might even fall below zero for a period of time. So it almost goes without saying at this point, but we see it as pretty temporary until this whole thing passes. Now, 2019 brought on some pretty huge gains, but those gains disappeared as the markets reacted to bad news. Stock valuations entered the year higher than historical averages here. So we did anticipate a little bit of a pullback, but this was unexpected by pretty well anybody. So the outcome of this sell-off brought valuations to their most compelling purchase points in over a decade. Since 2008, 2009, things dropped significantly. So we don't see this turbulence turning around tomorrow, but history has proven that short-term pain has been long-term gain, as cliche as that sounds. So despite the rockiness, though, that we felt this year, looking at the data over a long term, it teaches us that good years really don't have to be followed by bad years. And that's what we see here. And that's usually what people anticipate. It's been too good for too long. Something bad has to happen. So since 1978, which you can see here, the TSX rose, when the TSX rose by more than 20% in a given year, the average return the next year was still a solid 7%. So just because we had a strong year doesn't mean we have to have a bad year right behind it. So next question. So will global markets keep underperforming? So, crystal ball again, not back in the shop, or it's still back in the shop. But 2019 saw a global pace of growth decline with pretty significant geopolitical concerns and a few other issues. So by the end of the year, these concerns lightened, and we saw mostly green lights signaling a nice rebound in 2020. But as we were very rudely reminded in February and March, things come out of nowhere and send all our projections out the window. We saw it in 2015 when the Saudis flooded the oil market. We saw it again here with both COVID and the Saudis flooding the oil market yet again. So we do have a high level of uncertainty regarding the duration. We don't know yet. But as things progress and get better, we do expect a rebound because, again, due to the accommodative monetary policy from the government, fiscal stimulus from the government, and easier trading conditions with completion of phase one of the trading deal between China and US, which we tend to forget about. That did happen. So the big question, though, is when? Maybe this takes 2 years, maybe it takes 10 years for a full recovery. But what we do know is the world has always seemed to grow over time and not remain stagnant. So looking at this chart here, overseas stocks actually had a positive return in 8 of the past 10 years in their own local currencies. But the rising dollar here that we're dealing with, it's reduced returns in 2 of the past years for Canadian investors as our dollar gets as the dollar here gets stronger. So we do see our dollar strengthening in the first half of 2020 before flattening or falling as global growth stabilizes and rebounds. So we'll strengthen compared to others, and likely flatten as everyone else rebounds. So this increases the probability that Canadian investors gain positive returns in these stocks. So moving on, I'm actually going to skim through this one. China's playing a bigger role, substantially bigger. That's what this is explaining. But I'm not going to dive into a lot of detail here. China's a big part of the world now. They didn't used to be. We can see them growing, taking over market share.
5 more minutes, Mark.
Okay. So I'm going to skim through this because politics have never actually proven to show a big part of to do much to the stock market, or has been very temporary. They don't have a long-term play. So any risks to our outlook? So that's what I'm gonna stop on here. Any major risks? So let me just find my spot here. Debt is our major risk here. So what we're watching is household, corporate, and fiscal debt. Household debt is high. It's about 102% of Canadian GDP right now. And basically, for every dollar of disposable income that we have, the average Canadian has $1.76 of debt. So this huge debt load could absolutely slow the eventual recovery once activity starts to normalize. Now, low rates have given corporations incentive to take on a lot more debt. But corporate debt has doubled over the past decade in Canada, and U.S. corporate debt has risen to over $10.1 trillion, which is ridiculous at this point. But these high levels could trigger defaults from companies that we didn't anticipate it coming from, who have been hit the hardest over this whole thing, and could, again, be a drag on the recovery. Now, another threat here is the federal budget deficit, which has obviously increased even further. So Canada's debt to GDP remains relatively favorable at under 40%, but the growth rate in deficit spending in the U.S. was already high and was over $23 trillion was their debt load, and that is expected to rise going forward. So we do expect deficits to continue rising in 2020 as even more money is pumped into the economy, and over time this debt can lead to issues like high interest rates and less private investments due to these high borrowing costs. So we would hope low rates should help buffer some of these issues for 2020, but at some point we're going to have to pay the piper. Debt is high. So there is a bit more to this, but yeah, we'll end it there. If there are any other questions, let's.
You can continue down this because I think this is important, especially with all the government stimulus going on right now. You have 4 more minutes, Mark. So.
Okay, well, to be honest, there's not a whole ton more on the risk side for me. Those were were pretty well lit. I skimmed through them a little bit, but you know,
well, then we'll go to some questions here then.
Sure.
So we have one question that's asking, how do you see the current government stimulus package affecting both short-term and long-term?
Yeah, so there's a lot to unpack there, but in the short term, I mean, individually, it's incredibly helpful right now at a household level. Sorry, as we talked about this beforehand, but my
is it go time?
It is go time.
Okay, get out of here.
Perfect timing, right, for questions.
Perfect timing. So, thank you so much, Mark, for meeting with us. Go be with Amy. And
I appreciate you having me on, Alex. For everybody watching this, my wife is pregnant, and it's go time. So,
go.
I appreciate it. Have a good one.
Okay. See you, Mark.
See you.